Hey everyone, I'm Professor Stefan, and in this video we are going to talk about the amortization of intangible assets. So let's get started. So one of the tricky things with intangible assets is kind of this idea of how long do these things really last, right? They don't physically wear out like our PP&E, and so we have to come up with other ways to assess what their life is going to be. So we can take what we paid for them and turn it into an expense on our income statement, right? The idea here is if we're paying for these intangible assets, we want to match those costs to our revenues. And so we need to know what that revenue generating period is. And so we're going to divide our intangible assets up into two buckets. The first bucket are going to be finite-lived intangible assets. So these intangibles actually have an end date after which we expect them to not have any more value for us. We don't expect them to generate any more revenue. In a lot of cases, these finite lives are created by kind of the legal limits imposed on these intangible assets, like patents specifically, right, have a 20-year life. So you can imagine at the end of that 20-year life, the patent may have no more value because competitors will come in, there will be generic drugs or copies of whatever your invention is, and therefore the patent isn't worth anything after that 20-year period. Other intangible assets though, things like trademarks, are going to have indefinite lives. And so this is where it's not necessarily that we expect this intangible asset to last forever, but we just don't know when that thing is going to end. You know, there may be no limit on how long it can last legally, and we can't predict when the market is going to kind of stop seeing value in this trademark or the brand name that we have. We don't know when that value will run out. And so you can imagine for our finite-lived assets where we have a kind of fixed date after which it won't have value, it's going to be much easier to kind of allocate our costs into our income statement as expenses over the revenue generating period of that intangible. But for our indefinite-lived assets, we don't know when that life is going to end. So we don't know kind of how quickly to break that thing up into expenses on our income statement. And so what we're going to see in this video is that the finite-lived assets, we are going to amortize these things, which is basically just depreciation, but for intangibles. So we're going to divide them up over the revenue generating periods, just like our PP&E. And for the indefinite-lived assets, which we're going to see in class, instead of amortizing those kind of a little bit every period into expenses, instead, we're going to test them for impairment. So we're just going to look at it sometimes, maybe every year, maybe every other year, or when we need to. And we're going to say, hey, is this thing still really worth the value on our balance sheet, or do we need to lower that to some degree? So let's start by taking a look at our common intangible assets and whether these things have a finite life or an indefinite life. And so patents, we know, these are a right to use some sort of formula, a product, or a process. And legally, these are restricted to kind of a 20-year period that you have that exclusive right. And so because it is a finite 20-year period that you have exclusivity, it'll be a finite-lived asset, and we will amortize the cost of our patents into our income statement as an expense over that probably 20-year period. Now, if we expect the patent to kind of not have any use after 5 years or 10 years or 12 years, we may shorten the life. But otherwise, the default would be to say, hey, we expect value out of this for 20 years. So copyrights also have a finite life according to the law, where you have exclusive rights to that piece of art or that book to reproduce or sell it for the life of the creator until they die, plus an additional 70 years. Now, sometimes this copyright life gets extended, but theoretically, the copyright exclusivity should run out eventually. Now, there is some uncertainty with the copyrights in the sense of we don't know what the life of the creator is, but apparently we can, estimate that to some degree, and we'll start amortizing these copyrights over the expected useful life of, the copyright. Now, trademarks are trade names, which is kind of the right to use some sort of symbol or business name or brand name. Technically, these have a legal 20-year life, which would make you think that they should have a finite life. But these trademarks can be extended indefinitely. So you can always apply to kind of keep your trademark and make it last another 20 years. And you can do that as many times as you want. So in most cases, unless the company has a plan to phase out their trademark and stop using it, in most cases, they'll treat a trademark as having an indefinite life, and so they won't amortize that, but instead they'll just test it for impairment periodically. Customer lists, these could be finite if we expect that to kind of run out of value at some point. It could be indefinite if we see ongoing value and we don't know when it will end. So that one depends more on kind of how the company expects to use and how long they expect to use that customer list, or if they know the end date of it. Likewise, franchises don't follow kind of a simple formula, but rather it depends on the contract between the franchisor and the franchisee. Sometimes there's a limited life in that contract, sometimes it is indefinite, but the contract is going to determine whether we amortize what we paid for that franchise, or whether we just test it for impairment under an indefinite life scenario. And finally, goodwill, which is this excess of our purchase price over the fair market value of the assets, net assets that we're buying. That's going to have an indefinite life, right? There's no legal contract on kind of how long that goodwill kind of amorphous asset can last. And so we're going to treat it as an indefinite intangible asset, and it's going to have its own rules for kind of testing for impairment. So amortization, which applies to our finite lived assets. This is the systematic allocation of the cost of one of these intangibles over the shorter of the legal life of the asset, or its estimated actual useful life, or kind of its revenue generating period. So if my patent will last 20 years, but I expect to only use the product for 5, I'll go with a 5-year useful life for that patent. But we know it can go no longer than the 20-year legal life. Usually we are going to amortize these things on the straight line method, so we don't have to worry about those complicated depreciation methods we saw with PP&E. And usually we're going to assume that there is no residual value at the end of its life, because either we plan to stop using it, or its legal value, its kind of legal exclusivity runs out, and so then there's no value remaining. So when we record amortization, we're going to debit amortization expense, and in most cases we're going to credit kind of the intangible asset itself. In some cases, companies credit an accumulated amortization contra asset, just like accumulated depreciation, but for the most part, kind of crediting the asset itself is more common. I don't really care which one you guys do. It kind of gets you to the same place in the end. So this is one of those kind of small differences that in my mind doesn't really matter that much. So let's walk through a few examples so you can see kind of how amortization works and what might affect kind of changes in our amortization from what we had originally planned. So let's say we have a tech company and they acquire a patent for $15,000. So they're purchasing this externally, which means it gets capitalized on our balance sheet. And this patent has 15 years remaining on its useful life. They expect the patent to continue to generate cash over these 15 years, so they can go ahead and use it for its full legal life. And so if they're doing straight line amortization, there's no residual value that we know of. We're going to take our $15,000, divide it by its 15-year useful life, and amortize this thing for $1,000 per year. So we'll debit amortization expense for $1,000 and credit the patent asset for $1,000. Pretty straightforward. Now let's suppose at the beginning of year 6, the company has to defend this patent. So a patent troll comes along and say, hey, I actually own that patent, or I have this preceding patent that makes your patent worthless, and they sue the company. Now the company has to pay their lawyers $6,000 to defend this thing, and let's suppose that this defense is successful. So afterwards they get to continue to use this patent. Now what GAAP wants us to do is take this $6,000, and just like the cost of the patent, they want us to allocate the cost, allocate the expense over the revenue generating period. So just like depreciation for PP&E, just like the cost of the patent, this is an allocation type thing. So we're going to treat these legal expenses just like we would treat any other cost of the patent because they were successful. And so we would take this extra $5,000 that we spent. I forget if I said $6,000 in cost, but let's say it was $5,000. We're going to divide it over the 10 remaining years of the patent, and we'll allocate that expense in the amount of about an extra $500 in amortization over each of those 10 remaining years. So our total amortization expense will jump up to $1,500. Now this only works because the legal defense was successful. If it was unsuccessful and the patent loses all its value, right, there's no revenue generating periods to allocate it over. The patent has no value, so we just have to expense it as incurred. So another scenario, let's say they buy this patent and they have a commitment from another company to buy this patent in 5 years for $9,000. So the current company only wants to use it for 5 years and then they're going to sell it, and they know the eventual sales price is $5,000. Well, what they're going to do there is they're going to treat this just like a residual value and a shorter useful life. So we'll take our $15,000 cost, subtract the residual value of $9,000, and now we've got a depreciable cost or an amortizable cost of $6,000. So that's our total amortization. and we'll divide it over the 5 years that we're actually going to keep the patent. So we have amortization expenses of about $1,200 per year. Again, not really any different than the PP&E depreciation stuff that we've seen before. Different example here, let's say a company acquires a trademark for a line of cars several years ago when it bought another automobile company. The line of automobiles has been produced for 35 years. There's lots of different models under it, and the buyer of this trademark expects to continue using the trademark for the foreseeable future. They have no plans to stop this thing. Now, this is not going to be amortized because it would be one of these indefinite lived assets. They can continue to renew the trademark as long as they want. They have no plans to stop it, so we don't know what the amortization period would be or what the revenue generating period would be. And so instead of amortizing this, we're going to treat it like an indefinite lived asset and just test it for impairment periodically. Now, if we change the scenario just a little bit and we have this trademark, we're producing cars, and then management says, hey, we don't really want to use this brand name or this trademark anymore. We want to phase out this brand over the next 4 years. Well, then we would take the value of that trademark and we would amortize it over the remaining 4 years that we expect to generate revenue. And so then it would turn into one of these finite lived assets like we've seen in the other amortization examples. And so things can change over the lives of these intangible assets. So closing thoughts, our intangibles have either finite or indefinite lives, depending on whether we know how long it will last or we're pretty sure how long it will last, versus we just expect to continue using it as long as we can foresee. Finite lived intangibles are going to get amortized so that we allocate the cost over their revenue generating periods or over their useful lives. But the indefinite lived intangibles will not get amortized. We are just going to test those for impairment, which we're going to see in class. And finally, we sometimes have to adjust our amortization for new information, just like we did for PP&E. If we successfully defend a patent, that will kind of get allocated over the remaining life. If we unsuccessfully defend a patent, then we have to take the expense immediately. If we change the useful life of our asset or we switch from indefinite to a finite lived asset, that's going to change our amortization schedule. We could change our useful lives. We could change our residual values if for some reason that comes up. So things can change, and we're going to adjust just like we did for our long-term fixed assets. Thanks for watching.